I am recording this emergency update because something fundamental has just broken in the global silver market. China, through its Shanghai exchanges, has officially shattered the illusion of a unified global silver price. As I speak, silver on the Shanghai Gold Exchange is trading at an equivalent of $130 per ounce, while the COMEX in the United States is struggling to hold $83. That is a $47 gap, a 56% difference. In any functioning global market, a dislocation of this magnitude is impossible. It is a mathematical absurdity. Arbitrageurs would instantly buy in New York and sell in Shanghai, closing the gap within minutes. The fact that this gap is not closing, that it is in fact widening by the hour, tells you one thing and one thing only. The COMEX is broken. It has lost its ability to deliver metal. It has lost its credibility as a global price discovery mechanism. What we are witnessing is the great decoupling of the physical East from the paper West. China is on an unprecedented buying spree, hoovering up the world's physical silver and paying whatever price is necessary. Meanwhile, the Western banks are desperately trying to suppress the paper price to hide their own insolvency and the structural bankruptcy of the futures market. This dynamic cannot last. It is the endgame for the paper silver market as we know it. By the end of this video, you will understand exactly why this $47 gap exists, why the arbitrage mechanism has failed, what China's strategic objective is, and why this inevitably leads to a default on the COMEX and a repricing of silver to triple digits globally. Subscribe to Silver Media immediately and hit that notification bell. This story is developing faster than mainstream media can report it, assuming they ever will. You need to know what is happening before the gap closes violently. Like this video and comment to boost visibility. Share it with everyone because the COMEX era is ending before our eyes. Let me start with a deep dive into the numbers because they are staggering. As I record this, the Shanghai Futures Exchange, SHFE, and the Shanghai Gold Exchange, SGE, are quoting silver prices that, when converted from yuan to USD and adjusted for weight, equate to approximately $130 per ounce. This is not a brief spike. This price has been sustained and is climbing. Meanwhile, the COMEX spot price is hovering around $83. This spread, which I am calling the Shanghai arbitrage gap, is not a normal premium. For months, we've seen a Shanghai premium in the range of 5% to 10% that was already high and indicative of market stress. But in the last 48 hours, it has exploded. It went from $10 to $20, then $30, and now a chasm of $47. This is not a rounding error. This is not a temporary dislocation. This is a structural break in the global market. To put this in historical context, let me remind you of the last time we saw such dramatic price dislocations in the precious metals market. During the 2008 financial crisis, premiums on physical silver briefly spiked as the paper market collapsed, but they never approached anything close to 56%. During the 2020 pandemic panic, we saw temporary premiums of 20 to 30% on retail silver, but wholesale markets remained relatively connected. What we are seeing today is unprecedented. It is not a temporary dislocation caused by logistics or panic buying. It is a fundamental breakdown of the entire pricing mechanism that has governed the silver market for 5 decades. Why is this happening? Because China is panicking for physical metal. This is not just a few investors buying coins. This is a multifaceted national-level accumulation. The Chinese government has restricted exports, effectively trapping domestic production within its borders. The industrial sector, led by solar and electronics giants, is hoarding physical metal, building strategic reserves far beyond their immediate production needs. Chinese investors, terrified by a collapsing property market and a shaky currency, are fleeing into hard assets as a store of value. China, as a nation, is sucking up every available ounce of silver it can find on the global market. Let me break down each of these demand drivers in more detail because understanding them is critical to understanding why this premium is not going away anytime soon. First, the industrial demand. China produces over 80% of the world's solar panels, and each gigawatt of solar capacity requires approximately 20 to 30 tons of silver. The country has committed to installing hundreds of gigawatts of new solar capacity over the next decade. As part of its energy-independent strategy, this alone represents demand for tens of thousands of tons of silver metal that simply does not exist in current inventories. Chinese solar manufacturers are not waiting for spot purchases anymore. They are signing long-term offtake agreements directly with miners and refiners, paying premiums of 20, 30, even 50% above COMEX prices to lock in supply. They have done the math. They know that without silver, their factories stop. A 50% premium today is cheap insurance against a shutdown tomorrow. Second, the investment demand. The Chinese property market has wiped out trillions of dollars in household wealth. The stock market is volatile. The currency is under pressure. Where do Chinese citizens turn to protect their savings? Historically, gold has been the preferred safe haven, but gold has already repriced significantly higher, making it expensive for smaller investors. Silver offers a lower entry point with similar or even greater upside potential. The Shanghai Gold Exchange has reported record volumes in silver trading with retail participation surging. These are not speculators looking for quick profits. These are families converting their life savings into something the government cannot print or devalue. Third, the strategic government accumulation. This is perhaps the most secretive and most important driver. The Chinese government does not publish its silver reserves the way it reluctantly discloses gold holdings, but intelligence analysts and market watchers have pieced together a picture of systematic state-directed accumulation. Just as China stockpiled rare earth minerals before restricting exports and weaponizing them against Western technology companies, they are now doing the same with silver. The playbook is identical: accumulate quietly, control the supply, then dictate the terms. Normally, when a price gap like this opens, sophisticated arbitrageurs, the bullion banks, the major commodity trading houses rush in to close it. The trade is simple. Buy silver futures on COMEX for $83. Take delivery of the physical 1,000-ounce bars. Charter a plane and fly the bars to a Shanghai Gold Exchange approved vault in China. Sell the physical silver on the SGE for $130. Pocket the risk-free profit of $47 per ounce minus shipping and insurance on a standard 1,000-ounce bar. That's a profit of nearly $47,000. It is free money. Billions of dollars are sitting on the table waiting to be picked up. So why isn't it happening? Why is the gap widening instead of closing? The answer is terrifying for every paper holder in the world. You cannot get the metal out of COMEX. The arbitrage mechanism has failed because the delivery mechanism has failed. Traders know that if they stand for delivery on COMEX, they will not receive a warehouse receipt for immediate pickup. They will face delays. They will be offered cash settlements, often with a small premium to go away quietly, or they will be forced into an exchange for physical EFP maneuver, which routes their claim to the equally depleted London market. They cannot get the physical bars they need in the form they need fast enough to exploit the arbitrage. Furthermore, the COMEX inventory numbers are a fraud. The public reports on registered silver are down 75% from their peak, which is already an alarming figure. But the reality is worse. The metal that remains is likely encumbered. It has been pledged to multiple owners through leasing agreements. It has been pre-sold to industrial clients through private contracts. The available for delivery number is a lie. The real number of unencumbered deliverable silver is likely close to zero. Let me give you a concrete example of how this works. A bullion bank holds 10 million ounces in their COMEX vault, listed as registered and available for delivery, but that same metal has been leased to a mining company as collateral for a production loan. It has also been sold forward to an industrial buyer in Japan who has a delivery window in 6 months, and it has been used as margin for a hedge fund's short position. That same 10 million ounces appears on multiple balance sheets as an asset, but it can only physically be delivered to one counterparty. When multiple parties show up to collect, the fraud is exposed. We are approaching that moment, so the Western price of $83 is a phantom price. It is the price for a digital derivative, a paper contract that cannot be easily converted into the underlying asset. It has become a bet on a number detached from reality. The Shanghai price of $130 is the real price. It is the price for actual physical metal in a market that demands and verifies physical delivery. This distinction is critical. I want you to internalize it completely. When you look at the silver price on your Bloomberg terminal, on Kitco, on any Western price feed, you are not looking at the price of silver. You are looking at the price of a promise to deliver silver, a promise that is increasingly worthless. When the Shanghai Gold Exchange quotes $130, that is the price at which real metal is changing hands between verified vaults with audited inventory. That is the truth. Everything else is fiction. China knows this, and they are exploiting the West's weakness with strategic precision. By bidding up the physical price in a market where delivery is mandatory, the SGE, they are forcing the West to reveal its hand. They are effectively draining the last remaining physical inventory from the Western vaults. Every ounce that leaves a COMEX or LBMA vault and heads to China is an ounce that never comes back. It is gone from the Western paper ecosystem forever. This is a strategic attack. China is cornering the silver market just as they successfully cornered the rare earth market years ago. They know that silver is not just a precious metal, it is the most critical industrial metal of the 21st century. It is essential for the green energy transition, for artificial intelligence infrastructure, for 5G telecommunications, for military technology. The country that controls silver controls the future of technology. They are securing their supply while the West plays paper games. Consider the rare earth playbook. In 2010, China controlled over 95% of rare earth production and used that leverage to restrict exports during a diplomatic dispute with Japan. The world woke up to its vulnerability, but by then it was too late. Building alternative supply chains took over a decade and is still incomplete. Silver is following the same trajectory. China is the world's largest importer, and they are systematically removing physical supply from the global market. By the time the West realizes what has happened, the game will be over. The $47 gap is the death nail for COMEX. The primary function of a futures exchange is price discovery. If COMEX says silver is $83, but you can sell it for $130 in Shanghai, then COMEX is wrong. It is failing its most basic purpose. It is no longer a global price setter. It has become a regional paper market irrelevant to the global physical trade. As this gap persists and widens, liquidity will drain from COMEX at an accelerating rate. Why would a miner sell their production on COMEX at a 36% discount? They will bypass New York and London and sell directly to the east. Why would a refiner deliver their bars to COMEX when Shanghai pays a massive premium? The physical flow will reorient entirely to where the real price is being paid. This leaves COMEX as a hollow shell, a casino where paper speculators trade bets with each other with no metal to back the contracts. The open interest, which already dwarfs physical supply by a ratio of over 100 to 1, will become a pure work of fiction. It will be like a stock exchange trading shares in a company that no longer exists. The numbers move, the trades execute, but there is no underlying reality. Eventually, the COMEX must default or force a cash settlement. It is inevitable. They will have to announce to all remaining contract holders, "We are sorry, we have no silver to deliver. We will settle your contract in cash at the last traded price of $83. Meanwhile, the real price of silver globally will be $130, $150, or even higher. This is the scenario I have warned about for years on Silver Media, a decoupled market where paper holders get wiped out. They are paid in devaluing dollars at a fake suppressed price while physical holders get rich, owning the actual asset at its true unsuppressed market value. Let's talk about what this means for you right now as an investor. If you're looking at the COMEX spot price of 83 on your screen and thinking silver is cheap or expensive, you must stop. That price is irrelevant. It is a historical artifact from a dead system. The real price is $130. That is what the largest consumer nation in the world is paying. That is the price set by the physical market. This means if you can buy physical silver in the United States or Europe for anywhere near 80 plus a normal premium, you are getting the bargain of a lifetime. You are buying an asset at a 36% discount to its global market value. You are essentially acting as the arbitrage that the big banks cannot be. This retail arbitrage window will not stay open for long. Dealers will wake up. They will look at the Shanghai price. They will look at their dwindling inventories, and they will raise premiums to match the global reality. We are already seeing premiums rise to $20, $50 over spot. Soon those premiums might be $50, $60, or $80 to close the gap with Shanghai. You have a narrow window to execute this arbitrage yourself. Buy physical silver at Western prices before Western dealers adjust to the Shanghai reality. Let's look at the geopolitical angle because this is not just about markets. This is about a global power shift. China is not doing this by accident. This is a deliberate strategic part of the dollarization strategy. By breaking the pricing power of the Western-controlled COMEX and LBMA, China weakens the US dollar's control over global commodity pricing. For 50 years, the world has priced its most important commodities in dollars traded on Western exchanges. This has given the United States immense financial power, the ability to sanction, to freeze assets, to control global trade flows. If the world starts pricing silver in yuan on the Shanghai Exchange because that is where the physical volume and true price discovery are, the dollar loses another critical pillar of its hegemony. The $47 gap is a geopolitical weapon, and it is aimed directly at the heart of the dollar system. The BRICS nations are watching closely. Russia, India, Brazil, South Africa, and the growing list of countries seeking alternatives to dollar hegemony see what is happening in the silver market as a template. If China can break Western control over silver pricing, The same playbook can be applied to copper, to nickel, to uranium, to any strategic commodity. The entire architecture of dollar-denominated commodity markets is under assault. The US government knows this. They are not blind. That is why Vice President Vance recently announced price floors for critical minerals. They are trying to incentivize domestic production and keep physical metal within US borders. But price floors are a defensive measure. They are an admission of weakness. China is on the offense. They're actively draining the West of its physical supply while the US scrambles to figure out policy responses. The situation will likely unfold in a series of escalating steps. The drain accelerates. As long as the arbitrage gap exists, the flow of metal to the east will accelerate. Western vaults will hit zero effective inventory. Refiners will work around the clock to melt down. Panic in the West. Industrial users in the US, Tesla, Apple, military contractors, solar companies will realize they cannot source metal at COMEX prices. They will be forced to bid up the price in the West to compete with Shanghai for the scarce remaining supply. They cannot run their factories on paper contracts. When Apple cannot get silver for iPhone components, they will pay whatever is necessary. This will create a second wave of demand pressure that will overwhelm the paper shorts. COMEX repricing event. The paper price on COMEX will have to gap up violently to close the spread. This will not be a gradual climb. It will be an overnight event. We could see $83 go to $100, then $120 in a single trading session. The shorts will be obliterated in a squeeze of historic proportions. Banks with massive short positions will face margin calls they cannot meet. The losses could cascade through the entire financial system. Force majeure and default. If the shorts, backed by their captured exchanges, try to fight the repricing, COMEX may declare a force majeure event. They will suspend physical delivery and settle all remaining contracts in cash at the last traded artificial price. This would officially end COMEX as a physical market and expose the fraud to the entire world. It would be the financial equivalent of admitting that the emperor has no clothes. For you, the individual investor, the strategy is crystal clear and urgent. Get out of the paper system now. If COMEX fails, your SLV shares, your futures contracts, your unallocated accounts, they could all be settled at the artificial $83 price or frozen entirely while the lawyers figure it out. You could be holding paper that says you own silver while the real metal trades for $150 in Shanghai. The legal battles will take years. By then, the opportunity will be gone. Physical silver in your possession is the only way to guarantee you capture the true Shanghai price. If you own a silver eagle, it is worth what someone in the world will pay for it. If the global physical price is $130, your coin is worth $130 plus its numismatic premium, regardless of what the dead COMEX exchange says. Prioritize bars and coins from recognized mints. Avoid collectibles and focus on bullion weight. Store your metal securely, preferably in multiple locations. Consider allocated storage in jurisdictions outside the US banking system if you have significant holdings. And most importantly, stop waiting. The window's closing. This $40 gap is the smoking gun. It proves the manipulation. It proves the shortage. It proves the shift in global power from west to east. It proves that the paper market is a lie. Do not be fooled by the $83 price on your screen. It is a lie. The market is screaming the truth from Shanghai. Are you listening? The COMEX is a zombie walking. It is dead. It just hasn't fallen over yet. China just put a stake through its heart with a $130 bid. The question is not whether the paper market fails. The question is whether you're positioned correctly when it does. Position yourself now by physical. Ignore the paper price. The gap will close, and when it does, it will close violently to the upside. Those holding paper will be devastated. Those holding metal will be vindicated. Subscribe to Silver Media. I will be tracking the Shanghai Premium daily. This is the most critical indicator in the market right now. Share this video. The world needs to know the price is broken. The era of cheap paper suppressed silver is over. The era of Shanghai pricing has begun. History will mark this week as the moment the Western paper empire finally cracked. I will see you in the updates.